Good afternoon, everyone. This is Kim Schmidt, Executive Editor of Farm Equipment. Welcome to our latest webinar in conjunction with Franchise Equity Partners. Today's webinar will kick off with a pre-recorded presentation from George Russell of the Machinery Advisors Consortium on finding growth and capturing wealth. Following George's presentation, Jim Henderson, founder and managing partners of Exemplary Group and a member of MAC, and Mike Esposito, co-founder and managing partner of Franchise Equity Partners, will share some additional details, and then we'll open things up for questions from the audience. Before we get started, just a couple of housekeeping items. On your screen, there's a control panel with a Q&A icon. You can submit questions here at any time during the presentation. And then also just a reminder that we have recorded today's webinar in the event you want to come back and rewatch it or share it with anyone else on your staff. Okay, I think we're ready to get started. Thanks again for joining us, and we will go into George's presentation now.
Thanks, Kim. I'm excited today because this is the first in what we hope to become a series of webinars around that are thought starters meant to provoke dealers' thinkings about how to succeed as the second machine age dealer. We would hope that dealer principals and, for this session, financial executives at dealerships would take away from this webinar a better understanding of the new and more modern capital and funding sources that can help them fund their growth and help them diversify the wealth that they would have built around their dealership through the years and through the generations. We will touch here on some ideal returns on equity and assets. We're also introducing a term called equity engineering, funding growth and capturing capital. You'll see this as we get into this thought starter series. So again, it's the thought starter series in general is to spark creative thinking. We use the term at MAC, the second machine age, and there are virtues around the second machine age that we think are important. And this thought starter series should demonstrate that those virtues of being connected, collaborative, and adaptive. So we're definitely going to connect and collaborate with a company that we think is adapting to and having some different models in our industry that should be help some thinking. And that will be in the second part of this webinar between another colleague at MAC, Jim Henderson, and a company called Financial Equity Partners. Why is this particular thought starter topic important today? Clearly, over the years, the consolidation that we've been studying with Lester Publications, with the Big Dealer Report and the generational changes are accelerating, and particularly owners that may be thinking about either growth through acquisitions or the types of things they're doing are affecting their net worth in terms of their future. Those trends we've seen over time around consolidation are both at the producer level and at the manufacturer levels. And some of the incentives you have in a highly competitive market, there are clearly incentives to getting bigger. Another thing that at MAC that we have found over the years is that we've done a lot of work helping dealers work on their profit, work on their income statement, the ideal benchmarks for various expenses and the processes to get there. One of the things that we find is a need for dealers and dealer managers to learn more about managing their balance sheet, both how to manage it and what options they have. We've all heard and used the term cash is king because of the cyclicality of our business. Dealers get credit and employ capital, and for years measuring inventory turns and asset turns have been examples of the balance sheet. But in this growth environment, and particularly with some of the risks and opportunities with the changes in our industry, which are only going to get more, is how do you leverage debt and equity? And again, the vocabulary around those terms, leverage, debt, and equity, are things that we think are important for our dealer clients and dealers in general to better understand. So those are the couple of the reasons why this is important now. It's something that at MAC we're doing in our series and our theme for 2023 about how to manage in turbulent times. And when we work with our dealer clients, we are helping them better understand their capital structure and be able to have more stability as the business might be more turbulent. A third element that we've seen in our work with studying dealer dynamics over the years is more and more people that are interested in investing in farm equipment dealerships because they can be very good investments and bringing in new forms of equity building. There have been in the past the traditional family investors, and we talk to many of them who think in generations. There are the traditional private equity companies that may or have shorter time frames in terms of their investment in dealerships. And of course, dealers have always have access to bank loans and the more traditional forms of their local or national banks that they might help fund their growth or loans or alternatives to their other capital sources. So those have been the traditional types of investment in dealerships. Just a reminder of the dealer environment, as many of you who may have participated in the webinar that Kim and I did in December, which was an update of the big dealer, you notice on the lower left that the dealers on the move that Ag Equipment Intelligence and Farm Equipment do over the daily almost in terms of mergers and acquisitions events, you can see that pace is continuing at a very high level over the years with 40 to 60 events every year. The themes continue, consolidation, and we talked about now we're in a second phase of dealers, but buying other big dealers. And so the number of big dealers actually drops because of instead of having 2 or 3 big dealers, there's one. But there's also dealers coming in that are achieving that scale of 5 or more dealers with one locations with one owner. We're also seeing dealers either getting into other industries or other regions. Typically, those are ag dealers that might getting into construction equipment or construction equipment getting into the ag equipment. But there's other opportunities as well around maybe heavy truck or material handling. And certainly we've seen dealers in North America expanding in other parts of the world, Australia, New Zealand, Eastern Europe, and then particularly some European distributors coming into North America, particularly in Canada. And Kim and I have also been studying, and Lester Publications has been keeping a list of some of the private equity companies also coming in and some of the options there. Where that comes in terms of other options that we've seen for growth, we've seen some mergers where there's not necessarily been a injection of capital, but a evaluation of what the shares are of 2 different companies or 3 different companies, sometimes 9 different companies come together. A question we always get with dealers, and this comes back to how you generate capital internally. Typically, absorption is really not just a defensive measure, but is also, if you have high absorption, it helps you generate internal capital to grow. But if that's not coming fast enough, we're seeing more and more dealers looking externally at their ways to inject capital into their business from an outside source that helps them grow faster. So at MAC, just as what we do, we've got 3 different pillars: operational excellence to help dealers run their business better, the people development of leaders and managers and departmental leaders, and there where Jim Henderson later will be talking, we really have a third area which is around strategic growth for dealers. That's focused around developing those future-looking attributes of vision, bench strength, looking at the mergers and acquisitions as a process and helping dealers through that. And also we get many people who come to us looking to invest in farm equipment dealers. We can really tell what's happening in the general economy by the number of calls we get over the years. If the economy's down, we get more calls because farming and farm equipment is a good place in which to invest. Looking at the some of the education, and part of what we're looking at in terms of the title of equity engineering, this is a slide we use in some of our dealer training to connect and teach about the balance sheet and the relationship to the income statement. Balance sheet on the left, we flip things around a little bit. You can see liabilities and equity on the left, totaling the assets in the middle. There's various debt to equity ratios and asset turns that are built into that. And then you look at the income statement on the top. And one of the things that we teach is that relationship between the balance sheet and the income statement, and kind of give a rule of thumb that with those ratios, as you're growing, you need a 10-to-1 ratio between your capital to grow the financial side and have the financial stability to grow your business. That's the financial capital. There's also the human capital, the processes, and the other things as well. So that 10-to-1 capital ratio is assumed in this connection between the balance sheet and the income statement. We do work around in helping dealers with our work on what we call profit engineering to help engineer profit. And so you can see in this 20 to 24 million dealer, what that dealer, based on the various parameters, ought to be generating in profit. But what we're talking about here, and Jim and Mike will expand a little bit more, some of the elements around what we now call equity engineering, how you can apply the same analytical principles and the various relationships to help dealers and dealers' financial people that understand the various levers that can be pulled and various options in each of those areas on the balance sheet: debt, equity, the ratios of that, asset turns, which type of debt, what kind of assets, in those various elements. So this thought starter series will help to dealers engineer their balance sheet, various types of cases that dealers might be interested in. As I'm wanting to grow, how do I and grow personal wealth or wealth in the dealership, which would be represented as equity and net worth, and I'm pursuing a growth path that's continuing this mergers and acquisitions. How can I grow faster with engineering my balance sheet? What options do I have with internal, external capital in mergers versus acquisitions? What are the ways to leverage that outside capital? What are the various options that are available to do that, to help engineer the balance sheet? And frankly, there are a lot of dealers and dealer owners and that have spent their careers and maybe family generations in their business, and now it's time to make a transition, to retire, take some chips off the table and cash out, or even to diversify their businesses into other businesses to help them. In that case, they might want to exit a farm equipment dealership, get their hard-earned equity out of the business and use it for other purposes. So one of the connections that we've had that we at MAC, and Jim and I in particular, have learned from is a company called Financial Equity Partners. They've really helped spark our thinking about what various options dealers will have. And in this next section, Jim will introduce Mike Esposito of FEP. And I think in their dialogue, you'll learn some things that will help you engineer your balance sheet, generate capital for growth, and really help you with your future. So Jim, take it away.
Okay, great. Hey, I wanted to say hello to everybody and thank you for your time today. I'm Jim Henderson. I work with Machinery Advisors Consortium in strategic growth, specifically profit and equity engineering. One of the areas that we've been heavily involved with is this equity engineering area over the past few years, as we see dealers try to execute strategic growth as well as dealing with generational transitions. I'd like to introduce Franchise Equity Partners today as one of the what I'll call alternative equity partners interested in the heavy equipment space. And sometimes we see that equity partners are different today than in the past. And Mac's been working with FEP for the last year to educate them on the heavy equipment space. So with that, I'd like to introduce Mike Esposito. And Mike, will you take a minute and tell everyone about your background as well as your background on FEP?
Sure. Thanks a lot, Jim. Really appreciate the introduction. We've had the pleasure of working with the MAC team over the last 6 months. They've really helped us quite a bit in educating us on the heavy equipment space and the agricultural space. So my name is Mike Esposito, and I'm one of the co-founders of Franchise Equity Partners, or FEP. I spent most of my career at Goldman Sachs. I was there for 28 years and ran the Global Financial Institutions Group in investment banking. I was a partner for 20 years there and left during 2020. And along with another co-partner of mine, we co-founded Franchise Equity Partners. We launched about 15 months ago. And our purpose in life is to take minority equity stakes in franchisees. We focus on 5 verticals: heavy equipment dealers, auto dealers, restaurant franchisees, QSR, casual dining, beverage distribution, and other consumer and business services such as health, beauty, and fitness. I'll talk a little bit more about exactly the purpose of our company and how we can use our capital a little bit later on in the presentation. Thank you.
All right, Mike, I'm curious, as you've been looking at heavy equipment, what makes it an appealing space in which to invest?
We really do like the heavy equipment space quite a bit. It's got very good returns, very high cash-on-cash returns that are very attractive. The businesses are associated with these iconic brands: John Deere, Caterpillar, etc. And one of the things we just love about the businesses is the fact that they're family-owned. And they really kind of represent a lot of the underlying trends in the U.S. economy. There's consolidation going on in these verticals, and particularly in heavy equipment. Bigger can be better. We'll talk a little bit about why that is. The families being family-owned businesses are facing also multi-generational wealth transfer, which is another obvious common theme that's going on in the economy. And so as a result of the consolidation and intergenerational wealth transfer, there's just what we describe as a lot of money in motion, a lot of need for capital. And it creates a real opportunity for somebody like ourselves to try to provide that capital. And we love also the relationship with the OEMs. The exclusive territories that one gets, which creates moats, and the benefit from branding and other services that the OEMs provide. So all of that, we think, makes for a very attractive investing environment.
Got it. So why would a dealer look for outside capital that's minority, passive, and permanent? And how do they decide between the various sources of personal investment, with family and friends, banks, traditional PE firms? What would you say there?
Yeah. So first off, there's many different forms of capital. I would say the fork in the road starts with debt versus equity. And any finance textbook would say that debt is your cheapest source of capital. And we would recommend that one explores debt as a very, very attractive source of capital. Now, that being said, even though it's low cost, it comes with many issues. What we found is that many families are risk averse. They really don't like to take on a lot of debt on their balance sheet. And some of that has to do with the fact that these businesses can be very cyclical. Certainly commodity cycles in the case of ag can create short-term financial pressure, and the fixed costs associated with debt can create some problems. And so families oftentimes will avoid debt or avoid lots of debt. The OEMs also have restrictions on how much debt one can take on. And what we've noticed of all the investing verticals that we participate in, while debt's attractive, it seems to be least available in the heavy equipment sector. And I think that's because banks are less comfortable with the sector. They themselves have seen some of the cyclicality to it. And so we would definitely recommend people exploring expanding bank relationships. But at the end of the day, to solve some bigger capital issues, we do think that you need to ultimately turn towards equity capital.
Got it. So why expand further as to why a dealer may need equity capital? Help me understand that.
Yeah. So there are many different reasons why one might need equity capital, but we generally think about three buckets of uses. One is consolidation. The second is to clean up disinterested shareholders. And the third is to take money off the table and diversify. So let me spend a little time talking about each of those different sources or reasons for equity need. So the first is consolidation. We've clearly observed in all the industries we're participating in, as I said, much like the US economy, a long-term trend towards consolidation. And that's not just because bigger is better. That's not just because somebody wants to have an ego trip and build a bigger business. There are tangible benefits from having a larger scale business. So what are they? Some of the things that we think about are better vendor contracts, better OEM contracts. A lot of OEMs are looking to consolidate their vendor network and ultimately will help drive that through better incentives through more volume. So clearly vendor and OEM contracts can be better. Another key thing is that we've seen people build infrastructure above the store level and really develop best-in-class practices. So whether that be having a great HR function to attract the best people possible, or have a really good finance function or an IT function, by building the infrastructure above the store level, people can drive better economics. And that really is only affordable when you get to a certain size. You can also service larger customers. And as you start to service those larger customers, oftentimes it leads to greater balance sheet need. In the equipment sector, a good example of that is the need for rental services. Rental can be a great add-on business line. People talk about rent to rent, rent to sell, but we like the rental business, and we feel like the business is oftentimes moving that direction. But rental is inherently a more capital-intensive business, and so all of those reasons suggest greater consolidation, and potentially, as you do consolidation, a need to finance that with equity capital. So consolidation is reason one. Reason two is to cash out minority shareholders. What we've observed is in these family-owned businesses, as the businesses pass through the different generations, second, third, fourth generation, you oftentimes find a situation where there's disinterested shareholders. Shareholders that are no longer active in the business and are simply reliant on the business for taking out dividends, which is all fine, but it oftentimes can lead to tension within families. Active family members, working, putting that all together, and paying out the dividends to non-active family members. And as a result, we found that oftentimes leads to the need to take out the disinterested shareholders. So consolidation is one reason for outside capital. A second reason is to cash out minority shareholders. And then finally, the last reason we've seen is to diversify your wealth. Having grown up on Wall Street, one of the watchwords of Wall Street is diversification. Diversification with respect to your interests and your assets. What we've observed is in many family-owned businesses, there's a massive concentration of wealth in the family-owned business. And it's understandable because people feel like they understand the business. It's been in their family. They know all the people that work in their business. They're very comfortable with the OEM relationship that they have. And so there's a tendency to concentrate. But if any outside financial advisor looked at that, they'd probably say, gosh, you should really think about taking some chips off the table and diversifying some of your assets into other types of assets, whether it be equities or bonds or whatever it might be. And so the idea of having a financial investor just simply cash out the owner a bit to facilitate diversification is really the third reason. So consolidation, family cashing out disinterested shareholders, and then diversification. It's interesting too, because most owners of these family businesses are quite wealthy, we've noticed. And a lot of times people say to us, gosh, I don't really need any money. And the parallel I'll draw to some of this is our model is not new in the investing world. It's actually very similar to some other businesses that are out there. And there's a large number of companies that focus on private equity firms, i.e. investing in minority stakes in private equity firms and cashing out the owners of those private equity firms. Now, private equity owners are also very wealthy people, yet they've chosen to sell a stake. And I think it's in part their desire to diversify some of their holdings. And so that's really why we set up our company, because we see these needs and a lack of institutional capital providing it. Now, let me go on to say, as you think about bringing on a partner, how might you approach that? And, I would start by saying any family-owned business who decides to bring in an equity partner ought to be very deliberate in that process. And I'm sure anybody who's listening to this in that position would be. You've built up this very successful business over several generations in many cases, and you've done it kind of on your own acumen, your own financial muscle, and it's worked very, very well. And so when you bring in an equity partner, it's a very, very big decision, and we fully understand that. I think there'll always be some sort of legal document that codifies the terms of an investment and what rights the investor might have vis-a-vis the company. And legal documents obviously are important, but at the end of the day, legal documents are legal documents. And at the end of the day, really that relationship with somebody is critical. So to some extent, it depends on how much capital you need. When you're in a sort of less than 10 million, less than $5 million of equity need, we've noticed that there's many local angel investors that can fill that kind of capital need. And that makes a lot of sense. An angel investor, a local investor, is probably somebody you've known for a long period of time. There's a high degree of comfort and trust with that investor. And if you have access to that type of capital, we would strongly recommend it. However, as the capital need goes up, and you can debate how large it gets, but when it gets to something like $10 million or more, you start to fall into an institutional capital raise. And that's just a little bit different kettle of fish, if you will. And I would say first and foremost, you've got to find a partner that you like. There's all these branded institutional investors that you've probably heard of. But at the end of the day, brands are important, but people are much more important. And it's the investor that you're going to be interfacing with. It's the investor that you're going to be spending time with. And you're going to want to be comfortable with that person first and foremost. And so individuals are, in a lot of ways, more important than the brand. And then I'd ask yourself a series of questions. The first is, am I really strategically aligned with this person? The person's really got to understand your business. They've got to understand your aspirations in the business, where you want to go, how you think about things like succession planning. And so there needs to be a really good strategic alignment. These things don't happen overnight. They take time and education on both sides part. The second is, how much capital do I want and need over the short term and potentially over the longer term? And can this person provide that to me? Now, that really, again, speaks to what's your ambition. What we've noticed in many of the investments we're making is that people start and they want to buy a store or two, and then they want to consolidate a region, and then they want to consolidate a state, and then they want to consolidate a multi-state region. And if that is the case, that's going to take a serious amount of capital over time, and you're going to want to align yourself with somebody that can provide that kind of capital. And it's interesting, like we observed in the restaurant sector recently, where we were looking at a specific opportunity in the South that we liked quite a bit. And for a bunch of reasons, the seller went with a sponsor that didn't have any dedicated money, didn't have any dedicated funds. And what ended up happening was that sponsor, as they got into their due diligence, went out and tried to raise the money, and they failed. And they ended up coming back to us to try to sell the business. So again, I think part of this is, am I strategically aligned with the person? Do they have the money to fulfill my aspirations that are dedicated? And then the third question that's really critical is, what's my partner's investment horizon? All too often, institutional capital has a very short-term horizon, 3 to 5 years. And that doesn't jive very well with a family-owned business that has been in the business for 20, 30, 40, 50 or more years in some cases. And so what you really want to make sure is that you have capital that aligns with your objectives, your size, and your horizon. And it's obviously, again, got to be with somebody that you like and you want to spend time with.
Got it. So
Well, we lost your audio a little bit, Jim.
in that case,
Oh, you're back.
oh, well, I was going to ask. We know that FEP is a minority, permanent, and passive equity provider. Why would dealers work with you, Mike? What would make that?
Sure. So let me just touch on FEP and who we are and what we're trying to do. So I talked about the sectors we're focused on, and certainly heavy equipment, farm equipment is a very important sector for us. We're backed by an investment firm called HPS Investment Partners. And HPS was a subsidiary of JP Morgan until 2015. They're a large asset manager in New York. They have $100 billion of assets under management, and they've given us $1 billion to pursue the strategy. And so let me tell you a little bit about what we focus on. I don't think any of this would be a surprise. We look for investments that can produce returns in the high teens. Our returns come from two sources. One is distributions. So as an equity investor, we would get pro rata shares of dividends and things that you might distribute. And a second source of our return is growth in the business. And we're really indifferent as to where the return comes from. While we like dividends, and I'm sure many of the family members like dividends, we also see great merit in continuing to roll up these different industries. And unlike traditional PE or private equity, we don't need to monetize our investments. We're long-term investors that we feel much more like a family office than we do in private equity. And when we talk about our capital, there's really three watchwords we use all the time with respect to our capital: minority, passive, and permanent. Minority, passive, and permanent. So what does that mean? Minority, we're minority stake investors. We want to own less than 50% of the business, typically 20 to 40% of the business. And we typically do that in the form of common equity with no fixed returns or coupons expected on it. We're passive, which means that we really defer all day-to-day operating decisions to the owners. The owners have far more skin in the game than us. We're passive, we're a minority, and so they have more skin in the game than us. And we don't consider ourselves operators. We're not going to be able to tell you what's the best way to compensate a store manager. We're not going to be able to tell you how to price used inventory or what your expected turn rate should be in inventory. And so we're very much passive investors. And then finally, we're permanent. We set up these investments such that when we put the capital stays in the business permanently. We can't force you to sell. We can't force you to buy us back. And so unlike traditional private equity, we're very long-term focused. Why do we do this? We do this because we want to be friendly to the families, but we also want to be friendly to the OEMs. And what we've observed is there's a real lack of institutional capital in most of these sectors we're investing in. If you look at auto dealers, or you look at heavy equipment dealers, or you look at beverage distribution, there's really no private equity in those sectors. And the reason there's no private equity is because OEMs and suppliers are very reluctant to see private equity come into their industries. Why? Well, it's all those stereotypical reasons. The idea that the private equity firm is going to come in, they're going to control the board, they're going to control the operating decisions. They have short-term investment horizons, oftentimes 5 years or less, and then the business is going to be sold and it's going to change hands again. Oftentimes they pursue high leverage, and it could oftentimes strip the assets. And so there's a real reluctance on the part of OEMs to have private equity in. We've been successful, given the way that we structure our investments and the uniqueness of it. We've been successful in getting into many of these different industries. A very good example of that is on the auto side. where we've made now 2 investments, one in a group in the New York area, one in a group in the North Carolina, South Carolina area. And as part of that, we've been approved by 12 different OEMs in the auto space. And so we do think that our model is appealing to both the families that we're looking to invest with and the OEMs that are so important in this dynamic.
So can you give me an example of an investment you made and why the dealer chose to partner with you?
Yes. So perhaps a good example of one of our investments is in the auto dealer space in a group called Georgia Automotive Holdings. And this is a group that's got 20 dealership rooftops with 10 different OEMs in the New York, New Jersey, Pennsylvania, and Connecticut area. It's run by a owner named John Sobel, who's somebody that we've known for a long period of time. And he's been engineering a fairly aggressive roll-up of dealerships in that New York metropolitan area. We have known John for a long time. We like John quite a bit and what he's trying to do. And we ultimately made a $70 million investment for a 40% stake in his business. And what he did with the money was he basically deleveraged himself and then kept some cash on the balance sheet that gave him a lot of firepower to do more acquisitions. We closed that deal about 6 months ago, and because he's had additional firepower, he's now been able to do 2 subsequent transactions, one in Connecticut and one in New York, and he's probably now added a couple $100 million of revenue to what is a $1 billion revenue business. And so that would be a very, very typical sort of investment that we might make to help facilitate further consolidation.
Got it. So out of curiosity, is there value FEP provides to its partners other than being acceptable to the OEMs they partner with and allowing them to continue running their business as they like to?
Yeah, so one of the things that we try to do is add value. Now, I don't want to be accused of talking out of both sides of my mouth. We are passive, and again, we have no intention of telling anybody how to run their business. But we do find that our skill set can be complementary to the family businesses that we invest in. And so let me explain a little bit about what I mean by that. We've got an investment team in New York of people that really understand how to value businesses, how to think about the future of the business, the future cash flows of the business, and ultimately help structure transactions. And so we can become the outsourced corporate finance partner, if you will, to our investments. What does that mean? Again, as we have a vast network of relationships in the field, so we oftentimes see a lot of flow of opportunities. Our team then gets very involved in working with the principals at our investment to decide what the targets might look like, how we might value them, what the operating cash flows in the future will look like, to try to come up with values, and then ultimately help finance the transaction. In this transaction we did, an investment we just did in North Carolina, we've been working intensively with the dealer group to help refinance their debt with the banks. We've got a lot of great relationships with banks. We understand that process very well, and we can drive best terms. And that's in our interest, and that's in the dealer's interest. And so, that's a great example of how we can add value and be complementary to a dealer group. We are also looking at different opportunities to try to add value in areas that we understand. So, for example, in the auto space, insurance, reinsurance, and service contracts are a big part of the revenue stream for auto dealers. Auto dealers derive 25% of their profit from F&I. We've set up our own reinsurance platform. We're setting up relationships with TPAs. And so for dealers that are underpenetrated in finance and insurance, we can offer this turnkey outsourced solution. Obviously, this is something that's completely at the discretion of our partner. Our partner doesn't need to do this. But oftentimes we can demonstrate that this might be something that's revenue accretive to the dealership and therefore attractive to all shareholders. So those would be some examples. We really do want to be more than just money. We want to be value-added capital, and those are some of the ways we do it.
Got it. No, that makes a lot of sense. I do have a question here before we leave time for the audience to ask any questions. What does the process look like if somebody's wants to talk to FEP, and who would be good candidates that should reach out to you for more information? Just
Yes, we love meeting new firms, new companies, and we do this every day, all day long. As I said, we always say that we can make an investment decision, do all the due diligence, get through all the legal documents in 6 weeks' time. And if somebody has a deal to finance and they need equity capital, and somebody calls us, we can move very quickly. But what we found is that that's not the way life works. It's not the way we work, and it's not usually the way families work. And so what we generally do is we have multiple conversations, and we think that having a relationship, developing a relationship over a long period of time, having some meals together, and understanding many of the things I talked about up front in terms of understanding each person's objectives, desires, goals, ambitions, size, are really, really critical. And that just doesn't happen typically in 6 weeks. And so what we generally do is we start with a Zoom call. We start, if we can move forward from there, we generally would love to come out and see the company and see the people and see the operations firsthand. And we look at this as a long-term relationship business. Yes, ultimately we need to make investments, but it's really a long-term relationship business. And we know that the more relationships we have, the better off we're going to be. And ultimately, when we stumble upon an opportunity to buy something, we'll oftentimes call one of the operating partners we met months ago because it fits well from a business perspective, it fits well from a geographic perspective. And so we can start sourcing opportunities for some of the partners that we've been talking to. So, we're available all the time to do that. We'd love to do that. And if any of people on the phone would like to meet, we'd be very happy to see you on a Zoom call or otherwise.
okay.
All right. Then, Jim, if you are done with your questions, we can open it up to any attendees. If you guys have a question for Mike. We had one come through, Mike, but you answered it in your response to Jim. Is there a size dealership, whether that's number of stores or level of revenue, that is an ideal fit for working together?
Yeah, so that's a good question, and one that we get regularly. The short answer is a hard question to answer because every investment tends to have an initial investment and then ideally follow-on capital afterwards. Generally speaking, with $1 billion to invest, we'd probably want to have 20-ish companies across our 5 verticals in our portfolio, and therefore, our average ticket size, our average investment size for a minority stake would be $50 million. What we found is in certain of our verticals, $50 million for a minority stake is a large ticket, large transaction size. And so for certain sectors, and I would definitely put farm and heavy machinery into this bucket, we'll definitely go much lower than that. And it's hard to say where we officially would go. We'd certainly do something where we might go as low as $15 million for a minority stake, where there's an opportunity to put more money to work over time, where somebody has ambitions to consolidate a lot more. So that's our typical size parameters.
Okay, and then have you to date made investments in ag dealerships so far?
No, we have not. So thus far, we've made 5 investments. We've made these 2 auto dealer investments that I mentioned. We've made 2 restaurant investments. We're an owner of one of the largest Taco Bell businesses. We're an owner of a very large business around Auntie Anne's. And we've done 1 transaction in the beverage distribution space. At this point, we've not done an ag investment, and we're actively in conversations with people. And it's one of our goals this year is to make an ag investment in 2023.
All right. And then could you explain these three terms again: minority, passive, and permanent?
Yes, minority, passive, and permanent. So we want to be a minority investor, meaning that we own less than 50% of the firm. We want to be a significant shareholder, so we typically would look to own 20 to 40% of the firm. Again, that's generally, although not always, generally in the form of common equity, generally with no fixed return whatsoever. It's passive. So as a passive investor, we're not going to get involved in any of the day-to-day operating decisions of the firm. We really don't consider ourselves experts as such, and so we're going to be deferring all day-to-day operating decisions. We typically would have certain consent rights over very significant things, such as major leveraging, i.e. taking on debt above a certain level, significant divestitures, significant capital expenditures, in excess of what an OEM may require. So we typically have a handful of minority protections, but really no day-to-day influence in the business. And then finally, we're permanent. We can't force a sale of the business. We can't force you to buy back our stake. Once the capital goes into the business, it's in permanently.
Okay. And then if anyone wanted to get in touch with you, or if they wanted to learn more, what's the best way to go about those two things?
Yeah, so we have a website where you can see more information about us. It's fep-us.com. And our email addresses are all done the same way. So if anybody wants to reach out to me directly, mike.esposito, ESPOSITO, at fep-us.com. That's the best way to do it. But you can check us out on our website. And again, happy to interact and spend time with anybody on the call. I also see there's a question on board seats. And so board seats are kind of, then the question specifically is, do you require seats on the board of directors? And so what we've observed with family businesses is every family runs their business differently. Some families have boards of directors, sometimes even with outside directors, oftentimes just with family members. And other people have no such formal process. We're fine either way. We do not require a board seat, but what we do want is a regular cadence of interactions with the owner to understand how the business is performing. And we generally like to do that once a quarter. And so whether it's called a board meeting or it's called a management discussion, that's about the pacing of what we would normally do with most of our investments.
All right, we have time for a couple more questions if anyone had one. I see someone has hit the raise the hand icon if you want to type a question into the Q&A box if we haven't already gotten to you. All right. Are you open to all types of entities?
If that means we're certainly open.
Pass-throughs?
Yes. Yeah, we're very open to almost anything. We have plenty of smart people on staff that understands the different legal structures the organizations have. So, whether it's a C Corp, an LLC, any other kind of pass-through entity, we're perfectly comfortable with that. I think, as I've said, when it comes to heavy equipment, we're interested in construction, we're interested in ag, we're interested in materials handling, we're interested in heavy trucking. So we're open-minded on lots of different sectors. I might also say that we're also very flexible in how we structure our deals. And again, what we've observed in family-owned businesses is a propensity to own not just the operating business, i.e., not just the OEM dealer business, but also a lot of real estate. And what we've also observed is in many cases, owners have decided with the real estate to segregate that and to use that as an estate planning tool, i.e., to pass it on to their children and descendants. And it oftentimes there's then this separation of the operating business and the property business. And we're fine with that too. In other words, if somebody wants us to invest in both the operating business and the property business, we're perfectly comfortable with that. If somebody wants to split off the property business because they may have already given it through estate planning and the property business leases the real estate back to the operating business at fair market value, we're fine with that too. So, one of our keys is also try to be as flexible as possible to accommodate some of these family-related issues.
All right, that is all of the questions that have come through. So we will wrap things up. As I mentioned earlier, today's presentation will be available on the Farm Equipment website in the event anyone wants to go back and review it or share it with anyone else on their team. Keep an eye on your email on the Farm Equipment newsletter for more information on when that's available. On behalf of Mike, George, and Jim and the Franchise Equity Partners team, as well as the entire Farm Equipment staff, thanks for joining us for today's webinar. When you leave the webinar, you'll be directed to a short survey. Please feel free to reach out to us and let us know what you thought of the live event and if there's any topics you'd like us to cover in the future. Thanks again, everyone, and enjoy the rest of your day.